Hello traders, happy Independence Day to you all. Today is the 4th of July 2011, and happy Independence Day to you all. This video is about high frequency trading. What is high frequency trading? What is going on with the high frequency trading? What can we know about high frequency trading? Okay. In this video, we're going to talk about the technical trading method of high frequency traders. Okay, I repeat, a technical trading method of high frequency trading, and paying attention to what we call auto charting software, and also a chart pattern recognition software. Okay, now for those of you who are new to us, we are the TSTW SYS08 traders, and our website is www.stochastic-market. This video is for educational purposes only. Is neither a solicitation or an offer to buy or sell any financial instrument. For all trade, we must apply the 5% money management rule and use a stop loss in all trade. Very important. Okay. So what is high frequency trading? High frequency trading is a scalping. Okay, scalping, hot doors scalping at the highest level. Scalping at the highest level is a computerized scalping where institution or organization, okay, or trading firms will use, okay, a program, okay, to trade instead of human being, and a trading robot, so to speak, scalping a trading robot to enter and exit the trade within a short period of time. Okay, sometime a few seconds. Okay, and because these are, in fact, I prefer to call them speculators. These are speculators, but very smart speculators. Sometimes they work perfectly with the market. Sometimes they screw up the market, okay, so to speak. And I'm going to show you what is going on. And very recently, this is one subject people are talking about. But like I told you before, the price is the #1 indicator, and the price does not hide anything. Whatever is going on behind the scene, whether people the first thing you need to recognize that no one is smarter than the market. Okay, no one is smarter than the market. So if you hear people talking about smart trading, everything, if somebody is smart trader, they are trading together with the price. They are in harmony with the price. Okay, you can't be a smart trader trading against the stable data of the market. You have to work together with the stable data in the market, and then you can qualify as a smart trader. No one is smart. We are all followers. We are following the market. Okay, but the market first, the sector, okay, and then the individual financial instrument, the leaders, and the news, and the fundamental, the heart of the matter of the trading triangle. So smart traders will pay attention to this trading triangle constantly. But no one is smart trader. Okay. So what is going on with this high frequency trading? Okay, as you can see here on this chart, I draw a trend line. All I need to draw a trend line is 2 points. The price, a pivot level, like I showed you yesterday. The price turn around here, this is a pivot level. Price turn around again here, this is a pivot level. With 2 points, as soon as I have 2 points, I can join them together and draw my infinite trend line. You see? Okay, I leave it here into the future. Okay, this trend line is going to the future. I can come back to it anytime in the future. Okay, it's here. Okay, so as soon as the computer, what we call auto charting software, or the high frequency software, locate a trend line, okay, it will acknowledge it. So the price went down, isn't it? Price went down. Okay, and come back and retest the same declining trend line. The computer will sell here. Boom, down. Price come back again, retest a declining trend line. The computer will sell again, because the computer is not a human being. It's programmed to sell. And as soon as the criteria is fulfilled, The computer will not think, will not reason, it will just sell. So this is the danger of it. If you program a computer in a crazy manner, the computer will behave in a crazy manner. But the danger is that if you are trading wrongly and you are powerful, a bad trader, you create a lot of imperfection in the market, what we call a market distortion. Okay, which means you will see sometimes what we call a market exaggeration, because the computer is computer. It will just buy, create what we call exaggeration. When we see exaggeration or exhaustion, we human beings, because we think, we take advantage of it, unless somebody has got another program to take advantage of the imperfection. If you want to create a software, okay, to compete with the high frequency trader, you need to create a program that will detect a market imperfection, because these programs are creating a lot of a market imperfection, which is another opportunity for those who understand the language of the price, okay, because the price won't hide the imperfection or the exaggeration or the exhaustion or the distortion. The price will not hide it. It will reveal it clearly, neat, in front of all traders. Okay, so you will see that there is a distortion, and you will take advantage of it. So if you want to create a program that to compete with the high frequency trader, create a program that will recognize a market imperfection. One of the tools that you can use is the TS2050. The 20, our trading system that we give for trader for free. We somebody copy to their website. We see it. Somebody copy our program to put on the website, asking traders to give their email so they can send it to them. That's just cheating. Okay, we're going to do a video about that soon to show traders what is going on. Somebody copy your program, but you can perfectly use the TS2050 to locate. It's one of the tools to locate what we call a market imperfection. Okay, a market distortion. But there are other ways you can recognize a market distortion or a market exaggeration, just understanding the language of the price. Okay, so we talk about this trend line here. Now I want to show you another level here. You see this line, there's a support here, price touch it here, went up, touch it again, went up. Okay, now it did below it. Okay, here it did below it. Okay, look carefully here. The price came back and retest that level here. The computer will sell, because the price, this level here, is no more support. It's recognized as a weak support. Here it was a valid support because it turned around twice. Here it break it, so it's a weak support. Here again a weak support. Third time price retest a weak support, turning around, the computer will sell. It depends how those who are programming the programmers set the computer. So boom, down. Okay, now the tools that these people are using, I'm talking here about one part of the high frequency trading, which is the technical part of high frequency trading. Okay, you can see also that there was a support here and a support here, which is the price came back and retest that zone. Whenever you see a trend line, you see a trend line and a support or a resistance cross together. You see a trend line and a support or a resistance cross. That's usually a hotspot trading zone. You see this small triangle here formed by this horizontal line and the trend line. This angle here, this is a hotspot trading zone. You see this one also. You see this trend line here. Okay, and this one here. You see how they cross. The angle here, these are hot spot trading zone. This angle also here, this is a hot spot trading zone. Like I told traders, if you are trading stocks, you want volume, isn't it? Because for currency, we have volume very often, except in the Asia session. Okay, so somebody who is trading stock is always concerned about the volume. What I say to people who are trading stock, I say to them, trade stock that are listed on a Nasdaq 100 or a Dow 30 or a FTSE 100 or a CAC 40 or a DAX 30 on the major indices. You are likely to see volume. If there is no volume, you know that that day there was no volume, because the investor are obliged to invest in those what they call blue chips stocks. So the chances that you are likely to see volume. But if you are trading some of isolated stock somewhere, which you can perfectly trade, I'm not denying that, you must make sure that you have volume. One of the tools that we use is the hotspot trading zone. the hotspot trading zone. These are areas of interest for traders. Any trader that is willing to invest will pay attention to the hotspot trading zone. But if you are using the hotspot trading zone and you want to make investment decision, you must combine it with the fundamental. Check the balance sheet, like we told you before. Combine the balance sheet. If the balance sheet is solid and sound, and you have a very good, excellent hotspot trading zone, you can know that you locate, okay, a money zone or a high opportunity zone. Okay, so you want to combine the fundamental and the hotspot trading zone. The hotspot trading zone, okay, will attract the volume. It's not the other way around. Traders will locate the hotspot trading zone, placing the trade, creating the volume. But why they place the trade at the first place? Why they are interested in that zone? Because it's a hot spot trading zone. Okay, so again here I will show you. You see this point here and this point here. With these two pivot level, I can draw a trend line, which is this one here. That's today. Okay, so price came back and retest the same trend line. What the computer will do, buy, because it's a rising trend line. See the footstep of the smart money. Touch it, turn around, boom, they buy it. Okay, now we have a new trend line. This point where I'm rotating my cursor, and this point now. With these 2 points again, I can draw two lines. I can draw, I mean, a line, not two lines, one line. Okay, you see, price come back again, retest our new trend line, a rising trend line. Price went up fast and pulled back near a rising trend line. That's a buy. Okay, you see, it tried to come near this one. It couldn't touch it this time. Why? Because of a support level here where I'm placing my cursor. The horizontal line here, this is support level. You see, when the price was in this zone, it just touch it. You just touch it. You see, you just touch it here, and now we are coming back below it because New York is about to open. Like I said to you before, New York is a very New York is closed today. My apology, I'm just checking the time. New York is closed today because of the Independence Day, but I'm checking the time here. But other markets are opening because it's just something traders are doing all the time. Around 9:30, when New York is closed, if other markets are opening, okay, decisions are made around that time. Even though New York is closed, if another market is open, they will pay attention to that because decisions are made around that time, and they will make it. They will make it. Even though New York is shut, traders in New York can trade London or trade Frankfurt. They can trade other markets. So it's just the exchange that is closed, but it does not stop traders to trade other markets. So this is what traders forget. So if these traders have to make a decision today, even though the market's closed, today is the Independence Day, and some traders will pay attention to that time. That's what I'm saying to you. You see, so there is a bit of shift. That's what I'm talking about. A shift. A market is about to open, but the market is closed today. It's a opening time of a market. There's a shift in the market. You understand why the price coming below this trend line. Okay, you can understand. It happens all the time. It's what we call the gap period. A market opens, another market is about to open, there's a change, and a lot of traders get caught with that. Okay, so you see, just this is how the high frequency traders are trading, drawing the trend line and using the trend line and the support level with what we call auto charting software and also chart pattern recognition software. What is happening is that they are making the decision on a lower time frame. Okay, the madness, okay, that's my personal view. Okay, the madness of the high frequency trading is that some of the programs are the decisions are made only on the lower time frame. That's why it's mad, because normally if you're going to trade on a lower time frame, you need to combine one higher time frame with one lower time frame. So one particular higher time frame is tuned harmoniously to another lower time frame. That's how it works. The 2-minute chart is perfectly tuned to one particular time frame. I'm not going to say it. The 3-minute chart is perfectly tuned to another time frame. If you use a 4-hour chart, you have to know which time frame to combine it to. The daily chart is perfectly tuned to one particular time frame, the weekly chart to one particular time frame. That's how the market works harmoniously. Even though it looks chaotic, there are stable data in the market. If you break it, there will be any more market. Okay, So these programs, some of them, they make the decision completely on a lower time frame. By doing that, they're creating a lot of mess or market distortion, because instead of using a higher time frame before switching back to the lower time frame to make the decision, the program is set only on a 3-minute chart or a 2-minute chart. Okay, if you look carefully here, this is something happened just now in front of us. Okay, I show you. I'm going to draw another line here. Pay attention, because I have many lines here. We are looking at the USD yen currency pair. You see this horizontal line. You see this was the price drop here. If you follow my cursor, drop down and went up. It's a support level at this point in time. You see the price came and touched it here, the same level, found a resistance, went down. Okay, look what's happened. Again, the price returned to the same level. The computer will sell because it's sold here. You see, this is a weak support level, because the price found a support here, went up, only to come back below it. Okay, you found a support here, went up, okay, but it fell and come back below it. This is what we call capitulation. Okay, so see, so this is a weak support level can become a resistance easily. So this is what happened here. This is a weak support level. Now that weak support confirmed that yes, in fact, I'm a resistance level. So this is why the price went down. The computer noted that down and again sell here. But in fact, if you are looking on the higher time frame and all the other bits, you know that the computer shouldn't sell there. It shouldn't sell there. The price, if it was a human being making decision, intelligent decision, a harmonious decision, the price should break this level and went up. But because this is a computer making a decision, the computer will sell, forcing the price down. The danger of this is that these people using this program are powerful people. They have a lot of liquidity, a lot of money to move the market one way or another. By doing that, they create a lot of mess, or a lot of distortion, a lot of exaggeration, a lot of exhaustion, a lot of imperfection. But if you know how to recognize, okay, the imperfection, you can take advantage of it. But one day, this can be a huge mess, because a powerful bad trader is very dangerous. A powerful bad trader is dangerous for the market. And the best way to use those high frequency trading, talking about the technical part of the high frequency trading, is to learn properly, to combine, to use the multiple time frame properly, and then we'll have a better market. But if they are using the decision on a lower time frame, like we see it here, they will create a lot of mess in the market, and it's not going to be enjoyable anymore. You see, because these people, after they are entering the trend and they don't want to be too long, so for them a 2 point, 1 point, they are out and they dump it, and they go for the next signal, and the computer will sell again and dump it, and they are making money. But it's a bit unfair or ordinary traders, because a powerful trader making a decision like this, like a scalping like this, is crazy. It's almost crazy. Okay, and one day they will crash the market for no reason, because all you need is the criteria to line up nicely, and the computer will sell, unless there are other filters to avoid that. Okay, looking at this is the USD here. We look at the Euro USD. You see, this is the Euro USD. I will show you again the same thing about a high frequency trading. Okay, now I want to locate some. You see, now I want to show you one here. Okay, bear with me. This is the Euro USD, again on the 5-minute chart, using the high frequency. But you see the price touch this level here, and then at the same level here with 2 pivot points. We can draw a trend line. Okay, so this is our trend line here. You see, it's going down, going down. You see how the price came, try to retest that trend line here. You see, not only that, you see the price found a support here, try to go up, but break below it. You remember what I said to you before? A weak support level is a resistance level. Repeat, a weak support level is a resistance level, because the price did find a bit of support on this 5-minute chart, try to go up, but crash below it. That support level become a resistance level. A weak support level is a resistance level. Do not forget that. Okay, so the computer will know straight away that a weak support level is a resistance level. Price came back and retested a weak support level. Not only that, at the junction of a declining trend line, you have two criteria being met here: a declining channel, a declining trend line, plus a weak support zone. You are asking for it. It will go down. Okay, when you see two lines crossing like this, you know that you are in a hot spot. Not only hot, the hottest spot, a trading zone. Down. It will, by all means, it will. Okay, a weak support and a declining trend line. It will definitely. Now, this point here, you can see this point here. Okay, and this point here, it's a support level. We leave this line on the chart. We want to see today if the euro will come and retest that level. You see my trend line still here. I'm waiting to see if today we'll see one example like this. Probably will post a video for you so you can see. So we have this line already and watching it carefully. Okay, but all these lines, the computer will memorize it. It's there in the computer. They don't remove them. And if you pay attention also here, this point here and this point here, we can draw this trend line, a declining, okay, a declining trend line. And as you can see, the price came near the declining trend line. Okay, boom, again down. Okay, this is how the high frequency traders are trading, with the support, the resistance, and the trend line on the lower time frame without any consideration to the higher time frame. They are scalping hot dose, scalping madness. I mean, that's my personal view though. They are not mad, these are smart traders, okay, but what they are doing is a bit of madness in my view, and they create a lot of distortion and imperfection and mess market, because no consideration is made to the higher time frame or to the fundamental. I hope they pay attention to the fundamental at least, so it can create a lot of mess, and it's unfair because these people are controlling the market on the lower time frame. It's dangerous because if a trend is about to begin, the trend will begin from the lower time frame. At the same time, if the trend is about to change, the change will show up first on the lower time frame and then spread into the other time frame. So you may see it on the 1 minute, and then you see on the 2 minute chart, and then you see it in the 3 minute chart, and those on the 30 minute chart will see it, those on the 1 hour time will see it, and another one on the 2 hour time will see it. But if there's another change going to happen, you will see it on the lower time frame first. But the roots and the cause and the origin of the trend is always from the higher time frame. You see here the price went up and went down for a while. Okay, this is a typical resistance level from a higher time frame that moved the price fast like this. It's not by mistake. Here it's turning around. There must be a reason for this movement to continue. It might be supported by a valid support level from the higher time frame. But for the high frequency traders, they don't care about the higher time frame. They care about today. I mean, they don't even care for today. They care about 2 seconds, 5 seconds, 10-second profit very fast, without any consideration to the market pattern, to the stable data in the market. All they are concerned about is the support, the resistance, and the trend line on the lower time frame, and also based on their programs. Okay, so if you have many of these programs in the market, and right now they say there are more than 70% of the trade being taken by these high frequency program in the United States. You wonder why the United States market right now become a bit, you see a lot of distortion when New York opens. So it's perfectly good. So all traders need to do is to keep their eyes wide open and try to figure out the market imperfection. Okay, so this is just a quick video regarding a high frequency trading, and I hope you enjoy it, that you will put into practice in order to claim the market consistently. Happy Independence Day to you all. We are the TSTWSYS08 traders. Thank you for watching, and we will speak to you very soon.